Hi, everyone, again. This is Cathie Wood at ARK Invest. It is not Employment Friday. Next Friday is. Typically, it would be on the first Friday of the month, so I'm not sure why it is not today. We have our offsite next week, so we decided to do the video today, partly for that reason, but also because it has been a rough market, certainly for our style. And we wanted to talk about some of the issues out there and our response to them, and just make sure that we are here for you, and to give you a sense of comfort with what we're doing. And just remember, truth wins out. We're going to do things a little bit differently this time: fiscal policy, monetary policy, and then we'll just get right to what the heck is going on out there. Why is the market so skittish, particularly around growth stocks generally, and aggressive growth stocks in particular? And then we will end with a discussion of how our outlook is going to impact the various markets out there, and a little bit about ISS, which is a proxy solicitation firm, and we have a few things to say about what's going on out there in proxy land. Let's start with fiscal policy. There are log jams all over the place in Washington, whether we're talking about the debt ceiling. No, we're not going to shut the government down. They play this game almost every year. I think the cash is there until October 18th, maybe a little longer than that. So it's going to be an interesting couple of weeks, but we think they'll get the job done. They have no choice but to get it done. The infrastructure bill and the $3.5 trillion bill, social infrastructure bill, as it's called, those are also stuck in gridlock, very interestingly. Not just the gridlock between Democrats and Republicans, of course, but the gridlock that appears to be evolving between the progressive and moderate Democrats in the House. So as we have been expecting, with midterms roughly a year away, but the campaigns beginning now, we would be very surprised to see much in the way of serious tax increases go through. We thought for a time that perhaps there was some momentum building behind some of these tax increases, but that has stopped, it seems. And one of the reasons is polling of the swing states would suggest that those voters do not want their taxes to go up in the way that Congress is proposing. And I think that is going to matter. So that's good news for the stock market, actually. Monetary policy, the growth rate in M2 peaked at 27% earlier this year and has dropped to 13.4%. Last month was a little lower, but low teens now. So the big question about monetary policy is, when are they going to taper? Meaning, when will they stop quantitative easing, just buying bonds? And when will interest rates go up? Well, if our outlook is correct, neither one of those is going to happen. Maybe we'll get some tapering. And we've discussed before that we do not believe that's going to make much of a difference. The easing, or the quantitative easing that we have seen, a lot of that is just stuck on the central bank's balance sheet in the form of reserves. So they're kindling for loan growth. And if we were to light the kindling, meaning banks went crazy loaning money out, well, then we might have a boom, actually. That's not happening. In fact, quite the contrary. we are beginning to see the banks worrying about loan growth because of DeFi, decentralized finance, and the crypto world. And we do believe there is a lot of reason to worry. Regulators are going to insinuate themselves into that process, of course, and we'll see what happens. But DeFi is flying. Just to give you a sense of that, last year around this time, there was less than $10 billion locked in DeFi on the Ethereum network. Today, that is $120 billion. So at the margin, that is making a difference for the banks. We believe that the next big worry is going to be recession. We don't necessarily believe there will be one, but if we're right on what's going on out there and inventories are starting to build up, we've been saying for some time that the inventories in the system are much, much higher than I think most people appreciate. But where are they if they're not in the auto dealer lots? Well, they're in our garages and in our driveways. Everyone knows the familiar story of stocking up on paper goods. We're not going to have to buy them for quite some time. So a lot of inventories are in households. We believe that, and if we're right, we're probably going to be seeing some surprising stories about inventories out there at stores piling up, because we do believe that there has been a lot of double and triple ordering. And now that the consumer is shifting away from goods at the margin to services for obvious reasons, we're vaccinated, we're out and about now, there will be too much inventory, we believe, on the shelves. We're beginning to get some rumblings of this this week. Kohl's and Bed Bath and Beyond were hit hard. And I do believe that, and one of the reasons were downgrades. I think analysts are beginning to sniff out this excess inventory and the loss of demand as consumers move from goods at the margin, of course, to services. We also think there's another fear brewing out there, and it's China. Now, we hear a lot of headlines about China, but I'm not seeing many economists even integrate what's going on in China into their forecasts. China has been a powerful growth engine for the global economy for the last really 20 years. And they are changing their spots. Growth does not seem to be China's primary objective anymore. Common prosperity does. And they are restructuring in many ways. I think that's going to slow things down quite a bit, their economy. And of course, China has an impact not only on the rest of Asia, but especially Europe. I think Europe and China are much bigger trading partners than China and the US. Nonetheless, commodities are global. And so what hits China and these other economies is going to impact pricing. In fact, we're already seeing that, and I'll get into that in a moment. But let's talk about what the market's really worried about and why the impact has been so severe on fast-growing companies with high valuations, at least high valuations if one is looking at this year or next year. As you know, in our world, we're looking 5 years out. And we assume massive multiple compression over that time period to get to our price targets. Well, the market is really worried about inflation. And the headlines this week have been the highest rates we've seen in 38 to 40 years. And for some measures, that is true. I mean, the headline measures are concerning. I understand that. The PPI year over year is up 8.3%, CPI 5.3%. The personal consumption deflator up 4.3%. That last one is the one that the Fed pays a lot of attention to. So as you know, last year, we anticipated high inflation. It's a little higher than we thought, not much. One of the reasons was because of the base effect, the collapse in prices around the coronavirus last year. Well, we are passing through that, and still these numbers are high. So we do have to answer to that. And one of the reasons, and again, this is in the headlines quite a bit as well, are supply chain shortages. And some of those are real. We do believe the chip shortage is real, but we also believe that this notion that businesses were caught flat-footed during the coronavirus when they shut down, they just shut down, and then with stimulus checks, the consumer took off. Businesses have been scrambling for the last year to catch up with consumers. And to do so, we believe there has been a lot of double and triple ordering, ordering more than their own forecasts suggested would be necessary. And I think this is especially true in the chip sector and specifically in the auto sector. And that's the industry in trying to explain the collapse in its sales here in the United States from roughly 18.5 million cars sold to, that was in April, to it looks like 12.3, something like that in September. I mean, that's a recession-like decline. Well, one of the reasons that's happening is there was a lot of pre-buying last year in an effort to avoid mass transit. There was a huge rebound in the auto sector. It was a much sharper rebound than we've seen coming out of any other recession, including 08-09. So there was a lot of pre-buying. And when I say the inventory pileup is in the garage and the driveway, that's what I mean. We are hearing that that from a number of companies, Lisa Su at AMD, Elon Musk, both are saying, and then actually today GM said that they see the chip shortage loosening up here. And my guess is we're going to find out from price declines in chips just how much excess inventory there is out there. Before I continue with the auto sector, just if you look at Clorox and their sales, they've gone into decline. Why? Again, the inventories are in the households. Back to autos, we know that chip supply is starting to come on from not only Taiwan, incremental supply, but also Korea. My experience with Korea is that once it makes its mind to ramp in a sector, the ramp is significant and it's aggressive. So I don't think the chip shortage is going to be with us much longer. Now, on the auto sector, I would say the other thing that's happening is that now that consumers have bought that car and don't have to take mass transit, we're probably looking at a situation where the next car that consumers will want to buy is electric. And I think that that might be a part of what's going on with this dramatic decline in auto sales from 18.5 million to 12 million at an annual rate in the last month. I mean, again, we're not in a recession yet. I don't think that drop was just because of shortages. And I do think that the auto manufacturers have the wrong products in their pipeline. They'll have to switch much more quickly to electric if they can. Now, if we're right, then what we're going to see is prices coming down. I think of Wile E. Coyote running to catch up, as businesses have, and only to look down because the demand is not going to be as high as businesses expected. We are already seeing some prices come down. I've mentioned lumber. Since May, it's dropped 64%. Copper, 15%. Iron ore, think China in particular, down 51%. DRAM prices, so chips, down 20%. We've seen the dollar go up 5%. All of this is from the May-June time frame. These are all big anti-inflationary forces. They are also an indication when prices start going down. Anyone who has excess inventory is risking inventory losses, losing money on their inventories. So sometimes they will sell into that kind of price decline, exacerbating it. And I believe we're going to see a lot more of that. The one price that I think is unnerving a lot of people is the oil price. And it is threatening to go above its 2018 peak, which was just about $77. Almost got there this week and then backed off. It almost got there a few months ago and then backed off. So I don't know if that's resistance. I would tend to think it is, but I have been surprised before in other markets by oil prices and how much they can defy fundamentals. 2006 to 08, I think the oil price went from $60 to $130, and we were entering one of the worst periods of our financial lives. So what's going on here with oil that's so different from other commodities? Well, I don't think it's that different. I think China is going to have an impact on the oil price, especially now that it is shutting factories down in order to prepare for the Winter Olympics in February. They want a pristine environment, and as you know, they will have to work very hard to achieve that. So they're starting already. And as I mentioned before, there's a lot of uncertainty around the policies in China. But one of the things that I've been saying for quite some time is we do think the demand for oil globally has peaked. We think that it peaked in 2019. In 2019, it peaked, we believe, at 101 million barrels per day. We've rebounded this year to roughly 98 million barrels per day. And we would be surprised if we got back to the 101. China's part of the reason, and then the other very important reason is the shift, and we think it's taking place at an accelerated rate from gas-powered cars to electric vehicles. So on the demand side, we think demand is coming down for both cyclical and secular reasons. On the supply side, we've got some forces working against supply. So pension funds and activist investors are basically forcing a number of oil companies to cut their capital spending in the name of ESG, cut their capital spending on oil in particular. So ESG is having an impact here. We know that in the fracking part of the oil industry here in the United States, last year was a near-death experience, and the banks really started cutting back on their loans to frackers, and we think that is still the case. And then, of course, OPEC has been quite disciplined. And so here we are. The price is, unlike many other commodity prices, the price is near a short-term high here. Now, I've gotten a lot of flack for this on Twitter because last year I did say we think oil demand has peaked and that oil prices will come down. And we absolutely do stand by that point of view. At the turn of the last century, whale oil was heavily used for lighting and so forth. And as oil discoveries were made, the writing was on the wall, and whale oil manufacturers cut back on their capital spending. And so in the short term, that created huge volatility in the price. And I think we're probably seeing some of that now for a similar reason. But at the end of the day, demand ruled, and the price did implode. And we do think longer term that the oil price is on its way down. So just wanted to clarify that, since we did get, or I got so much flack about it. As you know, just to wrap up on inflation, we think deflation is the greater risk. And I know that's not a very widely held point of view. In fact, I don't think I know anyone who has that point of view. But you've heard some of the cyclical dynamics that we think will take inflation down. And we think secular dynamics will as well. Good deflation, that associated with disruptive innovation. And the statistic, I'm not sure if I mentioned it on the last call, but that blows my mind is artificial intelligence training costs are dropping 68% per year. Think about that. That's massive deflation. That's a huge undertow. And then the other side of disruptive innovation is creative destruction. So those companies who manufactured earnings by leveraging up to buy back their shares are probably didn't invest enough in innovation, and are going to see the results, we think, during the next few years. They will have to service their debt by cutting prices. Many people raise a couple of indicators to say, well, how do you deal with this as an explanation, given your view on deflation? Rents. Yes, rents are going up. But if you think about it, where's the great migration taking place? It's taking place from the very high rent areas of the world. So New York City, Silicon Valley, California, tri-state area. And the migration is to lower cost places and with lower rents than in those big cities. So I think that mix effect is going to help. And then the other one is on wages. Wage inflation, if you look at average hourly earnings, I think they were up 4.3% in the last employment report on a year-over-year basis. How do you overcome embedding 4.3% into the inflation rate? The way you do that is with productivity gains. And we believe that productivity gains are going to pick up significantly as our disruptive innovation technologies sweep through. And we think the changes are going to be massive during the next 5 to 10 years, with S-curves feeding S-curves feeding S-curves, and leading to tremendous productivity gains. So that's a win-win. Wages going up, productivity going up, will, I think, on a company-by-company basis, depending on their pricing power, they will either see share in the gains with higher margins, or maybe their margins will get hit if the pricing power is not there. So then let's talk about the markets to conclude. So stocks, the S&P 500 is up 15.6% this year. NASDAQ is up 12.7%. And as you know, our strategy, the flagship strategy, is down. Now, of course, last year, very strong results, way surpassing the markets, but nonetheless, in a correction. We have been in somewhat of a bear market, certainly for our strategy. If the definition of a bear market is from peak to trough, 20% or more, from February through May, we were down 35%. So there has been a bear market in our kind of stock. And we're seeing rolling corrections. I think the market has corrected, even though it's up double digit, it has corrected much more significantly than I think many appreciate. So we had the massive and aggressive rotation into value. And now we're seeing a movement. I mean, it's nip and tuck value and defensives, but we're seeing defensive sectors come on. So year to date, energy and financial services are the top two performers. Energy up 43%, financials up 29%. Those are classic value sectors. And then the next two top performers are real estate and consumer staples. Those are defensive. If we had looked at this at the end of May, all four of those would have been value. So industrials and materials would have been in the top four. So what is this telling us? Is it telling us, in terms of the defensive starting to outperform, are there concerns about fiscal policy and tax increases and the impact they will have on the economy? Well, you know our thoughts about that. Are there concerns about China and what that might do to cyclicals and other more value-oriented sectors? Yes, that's probably true. And are there concerns evolving about this inventory pileup issue that I described earlier? I will bet, as analysts are putting pen to paper or doing their spreadsheets, that they are beginning to put two and two together. I know that Bernstein was out in the last week or so saying, wait a minute, the shipment of chips into the auto industry is much stronger than the production levels we're seeing now, and certainly the sales levels. So analysts are beginning to get the plot, I think. So what's the next leg here that we think will cause a further rotation? Once these uncertainties are out there and it's clarified, there's an inventory correction, China's hitting economic growth, then I think inflation and interest rates are going to come down fairly dramatically. And the fear will shift from inflation or stagflation to deflation and or recession. And we will revert to very low nominal GDP growth rates, probably 2 to 3% range. In that context, our average revenue growth for our strategies is north of 25%. And I think the market will wake up once again to revenue growth rates that are 10 times that, 10 times that of the economy. So we're looking forward to that. What will this mean for fixed income? Well, treasuries they'll certainly stay low and perhaps rally more, maybe even breaking below the 112 we saw a month or so ago. However, corporate bond yields, if we're right, corporate bond yields will go up, so the spreads will widen. They're near record tight levels right now, which means the bond market really isn't worried about anything that I've just said. But we believe that will change. Commodity prices will continue down. And I believe oil will join the party, but hey, I was wrong in 06 and 08. 06 to 08, so can't be 100% sure about that. Just makes a lot of sense. And we think crypto prices, a new asset class, will continue to move up. It's very interesting to watch El Salvador. El Salvador has deemed Bitcoin legal tender, and its president tweets almost every day about this initiative. So far, 2.7 million out of the roughly 4 million eligible have downloaded their Chivo wallets with $30 worth of Bitcoin in it. What's interesting about that 2.7 million is only 1.2 million people in this country of 6 or 7 million people have checking accounts. So here's another example of DeFi, not even letting banks penetrate that highly into a country like El Salvador. It's also interesting to learn that today or in this week sometime, the government started mining Bitcoin using energy from its volcano. And we're wondering if they're going to actually include Bitcoin in their reserves, which we think would be a very smart thing to do. And the reason it would be smart is we're beginning to see the dollar's strength hitting emerging markets. A lot of emerging markets have dollar-denominated debt. So when the dollar goes up, it takes that much more to service the debt. From converting from their currencies into dollars. So this is often a harbinger of risk increasing in emerging markets. And very often there will be runs on the currency, and as their populations try to shift into dollars. So El Salvador is not going to have that problem this time. And we think other emerging markets are going to start taking its example. Many people wonder, why are we positive on crypto, especially Bitcoin, which is mathematically metered to top out at 21 million units. We're somewhere between 18.5 and 19, I think now. And yes, that's if there were an inflation, that's a beautiful hedge. But when you're talking about emerging markets or you're talking about a situation like 08, 09 here in the United States, when there's a crisis, counterparty risk is high and rising. So to have a backstop like Bitcoin, we think is an excellent insurance policy. Now I'll end on something that happened this week, which is, I just said, really? So ISS, which is a proxy solicitation firm, and it's owned by Deutsche Börse, which I didn't remember until I started digging a little bit, recommended that Five9 shareholders vote against Zoom's acquisition of Five9. And what happened? Institutional investors basically followed ISS's lead. And I was struck by that because I'm saying, wait a minute, ISS doesn't know anything about how Five9 and Zoom will fit together. They don't have technology analysts. They don't have portfolio managers. We wrote a piece. You can find it out there on Twitter because I linked to it, basically saying, wait a minute, you have no idea what this combination would do for 5.9, and it actually do more for 5.9 than it would for Zoom. And so we wrote up our Zoom outlook. We really do believe Zoom is the new fabric, which is pulling together the new communications ecosystem, enterprise communications. We're just that COVID launched this movement, and we're in very early stages, and we believe Zoom it has the best technology and has the best shot at winning this winner take most game. Enterprise communications in the enterprise tech stack is the largest part of the tech stack. Globally, I think it's $1.4 trillion. And we have very old infrastructure that we believe now, with the hybrid work in this digital world, is going to transform completely. And we think, as I mentioned, Zoom has a very good shot at being the leader. So we wrote a piece, and William Summerlin, who with Andrew Kim put together that report, linked to a Cleary Gottlieb piece about the proxy solicitation firms and how institutional investors are abdicating their responsibilities as shareholders to institutions that are not in the research game and are not in the portfolio management game. And it's just shocking that it's gone this far. Now, I don't know if no one really paid attention to our tweet, not in any great measure at least, or to that link. But really, we've got to take responsibility for and do our share as shareholders for our companies, and not abdicate our responsibilities to individuals and institutions who know nothing about what these companies do and probably don't care. They have their own agenda, and it's revolving around ESG and all manner of things that maybe it should not. It's really on a company by company basis. There's a lot of greenwashing going on out there, and I think it's because of institutions like ISS. So anyway, on my soapbox, that's where I'll end. But we are looking forward to the next rotation in the stock market, and we do think it will be back towards the amazing growth companies that are going to transform our world completely and really make it better. So looking forward to that, and looking forward to any response, constructive criticism you have. I'm sure I'll hear it. And looking forward to next time. Thanks so much.